So Abbott Laboratories just got approved for COVID rapid testing. Should you be buying shares now? Hey, and welcome back to another video here at FiscalVoyage. My name is Felix. So I want to do this video because of the news of Abbott Laboratories rapid COVID-19 testing. This is really big news, and I think it could drive the price of Abbott Laboratories much higher. But in this video, we're going to determine if Abbott Laboratories is actually fairly valued or undervalued right now, or even substantially overvalued. Because even with this big news, it's very important that if you were to buy shares of this company, that to buy it at fairly value, even slightly overvalued. So I'm going to provide you with a stock analysis of the company, and later in the end of the video, I'm going to provide a fair value price as well as my recommendation. Before we get started, in the description, there's a free ebook, so make sure to check that out. So Abbott Laboratory, as you see here, just announced a $5 15-minute easy-to-use COVID-19 antigen test, which passed the FDA approval. You can see here's the announcement on August 26th. Abbott, ticker symbol ABT, announced today that the U.S. Food and Drug Administration, FDA, has issued an emergency use authorization, EUA, for its BinaxNOW COVID-19 Ag Card Rapid Test for detection of COVID-19 infection. Abbott will sell this test for $5, and it is a highly portable, about the size of a credit card, affordable, provides results in 15 minutes. BinaxNOWs use proven Abbott lateral flow technology, making it a reliable and familiar format for frequent mass testing through their healthcare provider with no equipment required. The device will be an important tool to manage risks and quickly identify infectious people so that the spread the disease to others. So they don't spread the disease to others. So that's very positive news. So let's do a stock analysis on Abbott to see if it's a good price right now, because it's something like this would definitely drive the price much higher. All right, Abbott Laboratories, ticker symbol ABT. The company is a medical device and healthcare company. Sells medical devices, diagnostics, branded generic medicines, and nutritional products. Let's look at the fundamentals for Abbott. From 2010 to 2019, revenue actually had a compound growth of negative 1.1%, so it's lower in 2019 revenue versus the 2010 revenue. So that's something to look at. Net income grew at a negative rate as well, at negative 2.5% for that same time period, 2010 to 2019. However, the company does have a negative credit rating, which is investment grade. So the quality of this company is very good, and the balance sheet is very good as well. We'll look at that in a few slides from here. Operating income also was negative at negative 3.2% growth. So as you can see here, the revenue, net income, and operating income has been negative. But on the bright side, the 5-year average has been much better. We'll talk about that shortly. Earnings per share growth was 5.5% for this 10-year period. So for the 5-year average, earnings grew at a much better rate, basically double, at 10.8% growth for the past 5 years. So they've seen tremendous growth compared to the 10-year average. So that's very positive there. Net income 5-year average dropped double at negative 4.5%. So if you were to consider investing in this company, I would read their annual reports and see why net income has decreased. Revenue, however, for the past 5 years has jumped tremendously to 11.8%. So that's a much better rate than the 10-year average of negative 1.1%. So for the 10 years, it wasn't looking good for the company, but the past 5 years much better. But even though the past 10 years, the company price has been increasing tremendously. And I think that's because earnings has been increasing. Like I like to say, price follows earnings. Let's continue with the fundamentals. For 2019, the company earned $3.24 in adjusted earnings. Net margin came in at 11.6%, which was much higher than 2018 of 7.7%. So that's very positive. That's good to see net margin increasing. You always like to see net margin increasing year over year versus decreasing. It means more profit into your pocket. Return on equity 5-year average is about 8.7. They fluctuate. They've gone as high as mid 15s area up to 20. but the past 5-year average has been 8.7%. Currently, the company has a dividend yield of 1.29. It is lower than the S&P 500 current yield at 1.76%. So it doesn't beat the market yield, but it has a 1.29% dividend, and however it does grow the dividend at a nice rate of 7.8%. And the most recent increase was in January this year at 12.5%. So that's very positive. I like to see the 5-year dividend growth rate, and then compared to the most recent increase, I like to see the recent increase to be much higher than the past 5 years. So that's very positive there. The dividend payout ratio is only 43.9%. Forgot the percent symbol there. Excuse me. But it's 43.9% dividend payout ratio. So the dividend is very well covered. It's safe. It's a nice payout ratio. So they should be able to continue to grow the dividend between the 8, and 10%, 11% growth. So that's positive there. And they've been growing dividends for 7+ years as Abbott Laboratory. Net margin, or excuse me, charter rule is at 9.1, so it's lower than the my criteria of 10, 11, or even 12. So that's something to consider there. But I think this number is going to be higher because, as you can see, the most recent increase was 12.5%. So that number should be increasing in the next few years. The 5-year dividend yield average is 1.93%. So the current yield is much lower than the 5-year average. So that might be an indicator that it may be overvalued. I like to value company based on the dividend yield average over 5 and 10-year period, and you get a more or less accurate estimate if it's overvalued or undervalued based on that as well. So let's continue with the balance sheet. Like I said, is a very solid balance sheet. Debt to cap at only 36%. So it's not great, but it's real good. Current ratio at 1.57 is right at our criteria of 1.5 or higher. Debt to equity is really good here at 0.64 ratio, so that's real good, solid. I like to see it under 1. And interest coverage is higher than the 2.5 minimum criteria at 6.8, so that's very positive. So the balance sheet does look good for this company, as well as the credit rating, so everything here is positive. Price to book ratio at 6.43 is higher than the 5-year average of 3.36, almost double the 5-year average. So that might be an indicator as well that the company may be overvalued if you evaluate it by price to book ratio. So let's look at the future outlook for this company, for Abbott. You can see here for 2020, analysts are expecting earnings to be about $3.25. This is a penny higher than 2019 of $3.24. So that's, it's not great, but it's better than lower earnings than 2019. So that's positive. Of course, with all the things that's going on in 2020. For 2021, they're expected to have a nice increase at $3.97. And CFRA is projecting a 3-year annual growth rate of about 14%. Other analysts are expecting about 10 to 11%, so just FYI there. But CFRA is expecting a 14% earnings growth. My dividend drill return model has a projected total return of 10.1%, so it's right there in my criteria of 9% or higher, so that's positive there. And a negative here is the forward PE is 33.9 versus a 5-year PE average of 22.9. So you can see the PE is almost 10 basis point, 10 PE higher than the 5-year average, and the current PE is 34.1. So the forward PE is slightly lower because the earnings are expected to be, up by a penny or so. So based on the PE ratio, it does look overvalued. And if we're having a PE of 33.9 and only a growth about 11 or 14%. Earnings growth, so that may be a concern that the company may be overvalued in today's prices. So let's look at the fast graph for this company. All right, so let's look at the fast graph here for Abbott Laboratories. As you can see here, the company has been very solid. Even in 2008, 2009, the company was growing earnings 17% in 2008 and 12% in 2009. So that's very impressive. I really like that a lot. Even though the price dropped, but the company was making money and increasing earnings. So they, in the early 2000s, they were very nice earnings growth. They struggled here in 2013 with a negative 17% growth.
and a negative 6% in 2015. But they're picking it right back up, as you can see here, 14%, 15%, 13%. So that's very positive. And actually, this is when the company started to just blow up. You can see here in 2017, it increased 14%, and just since then, the price for this company has increased dramatically. So if we were to to get an average around here to here, you had a almost 30% annual rate of return since that time period. So that's amazing. If you were to lucky enough to purchase shares here, great investment. But as you can see here, the company is much higher than the blue and orange line, which is based on fast graph, is an indicator that it's overvalued. The company in the history likes to follow a PE around 19.4. We'll just say 20. But if we shorten this time period, you can see it has about 20.1 PE that it likes to follow. So you can see here, the company has a PE about 34.1, and if we were to go back to the average of about 20.1, you can see the annual total return will be negative 7.7%. You have potential of losing money here at this price point. So this is why, based on fast graph, it looks to be overvalued. I personally look at this company, I would like to buy it anywhere under PE of 20, because this is going to be a long-term long-term safe company, because nice credit rating, low debt to cap ratio. So long term, this company is outstanding, but at current prices, it looks to be overvalued. Let's look at the analyst scorecard. For the 1 year margin error, analysts have been correct about 91% of the time, and the 2 year about 91% of the time as well. So that's very positive. So I'm very confident in the earnings here for this company, that the analysts are pretty accurate with it here. All right, so here's the fair value price slide. CFRA has a fair price of $86.62, Morningstar at 80. Fast graph, as you just saw, $85.47. This is based on 2021 expected earnings. Yahoo at $108.31, and my dividend discount model analysis at $82.08. For my dividend discount model analysis, I use a 10% growth for the next 3 years and 8% after that, with a discount rate of 10%. That's how I came to $82.08. Averaging out to 5, we get a fair price of $88.50. And currently, as of today, the price for Abbott Laboratories is $110.79. So I mean, the company is overvalued by 20%. Based on my fair value calculation, based on the PE, price to book, and dividend yield, you can see that the company is overvalued about 20%. So that's why I have a recommendation as a hold for Abbott Laboratories. So there you have it. I have Abbott Laboratory as a hold right now. I think the company is an amazing company. I personally want to own shares of this company, but the valuation is very, very high. And right now, I feel like if I was to buy shares, I'm basically speculating that this rapid testing is going to help drive even the share higher. I think long term, this company is going to be here for a very long time and be very profitable. And like I said, I do want to buy shares of this company. It's just not right now. It has over 30 PE. Earnings are expected to grow in the low 10, 15, between 10 and 15 growth. So that doesn't correlate very well with that high PE ratio right now. That's why I have Abbott Laboratory stock as a hold right now. So thank you for watching, and make sure to hit that like button. And if you're new to the channel, make sure to hit that subscribe button, as well as check out my free ebook in the description below. Thanks again, and I'll see you guys in the next one.